This is Sovrun, your guide to financial literacy. Today we're measuring the real cost of every dollar of return. Remember when savings accounts paid basically nothing? Those days are over. With treasury bills now yielding 4 to 5%, your portfolio has to beat that just to justify the risk. That's exactly what the Sharpe Ratio measures. Welcome to Sharpe Ratio. The Sharpe Ratio is like miles per gallon for your investments. Instead of measuring fuel efficiency, it measures risk efficiency. Imagine 2 road trips, same destination, 500 miles. One car burns 10 gallons, the other burns 30. Same outcome, wildly different efficiency. That's the Sharpe Ratio. How much return are you getting for each unit of risk you take? Here's the formula. Sharpe Ratio equals your portfolio return minus the risk-free rate, all divided by your portfolio standard deviation. Let's walk through it. Say your portfolio returned 12%. The risk-free rate is 4%. Subtract them. 12 minus 4 gives 8% excess return. Your portfolio's volatility is 10%. Now divide 8% by 10%, and you get a Sharpe ratio of 0.80. Not bad. You earn 0.8 units of return for every unit of risk. So where does 0.80 stack up? US bonds sit around 0.25. The S&P 500 long-term average? About 0.45. The NASDAQ a bit higher at 0.55. Warren Buffett's lifetime Sharpe. An impressive 0.76. A good hedge fund targets 1.0. And the medallion fund? Above 2.0. Anything above 1 is considered excellent. In 2023, NVIDIA returned about 240%. Sounds incredible, right? But with a standard deviation of 55% and a risk-free rate of 5%, its Sharpe ratio was about 4.3. Off the charts. But here's the lesson. That's 1 year. Over longer periods, individual stocks rarely maintain a Sharpe above 1. Even William Sharpe himself said sustained ratios above 1 are rare. Here's the thing. Returns alone are meaningless without context. A 20% return with 40% volatility, that's reckless gambling. A 10% return with 5% volatility, that's skillful investing. The Sharpe ratio separates luck from skill. It's the gold standard for comparing any two investments fairly. And the Sharpe concept isn't just for finance. It's manufacturing output per defect rate, sports analytics, points per possession, even project value delivered per resource spent. Follow Sovrun for more financial insights.